Good afternoon, everybody.
Hello, guys.
Hello.
So what are we talking about today?
Crypto.
Crypto and the quality of that microphone.
It's pretty
Yeah.
cool, isn't it?
It's a solid mic.
Is that part of that old school vinyl setup?
Come on now. You're jumping too fast into it, Ari. We're going to plug my other side projects later.
Hey, don't feel bad. My vinyl's literally right next to me right now.
All right, maybe we could just talk about vinyl for an hour. That works for me. No, come on. People want to talk about crypto. How's everybody doing? How are you, Constantine?
Top of the world.
Well, I don't think anybody's going to be running this, although Ari kept raising my hand. But I'm happy to jump in if you guys like it. Throw some ideas out. How does that sound?
Sounds perfect.
Sounds great.
I think loosely what we want to talk about is institutional and retail crypto markets. That's a pretty broad topic. We could speak for a couple hours, I guess, if anybody's still listening. There's a lot going on in the space. Does anybody want to jump in and give us your view on what's happened since Jan 1 for starters? How's that sound?
Yeah, I'm happy to hop on in there. Constantine, if you wanna jump, by all means.
Yeah, and go ahead, and then I'll add. I just presented this similar topic like yesterday on the other conference. So yeah, so fresh.
I mean, in particular, the retail markets, just in general, whether it's crypto or otherwise, are in a series of upheaval at the moment. I mean, especially if you're following what's going on in the retail markets, just traditionally with Robinhood and such. From our perspective at Republic, one of the big things that really caused a lot of the upward velocity in the retail markets in particular was OCC approving banks to be able to custody assets, right? I mean, most of the run up, whether people realize it or not, has been almost entirely driven by institutional access. And institutionals, for the most part, didn't have access until that judgment. Most hedge funds, pension funds, private equity groups, their charters prevented them from participating in most of the crypto upside because they couldn't participate in assets that could not be custodied and could not be insured. And that judgment in the middle of December basically changed that entire landscape. And now you see a lot of funds taking, maybe a 5% AUM exposure to the crypto markets, most of which is Bitcoin driven, just because they have to. I mean, you just kind of look silly if you don't have at least a little exposure to it. So, I know from the Republic side and the institutionals that we work with, I mean, we were seeing absolutely huge buy orders, 100 million there, 200 million there. I mean, really to the point there just wasn't enough supply. And that's kind of what really caused this huge run up that really seemed to have no end to it until most of those funds got the exposure that they needed. There's going to be another round here as the capital calls take place in Q2. But I think that's really the fundamental aspect of what's driven the markets here over the past month and a half, 2 months or so. So really interested to see how that shakes out further, especially as these capital calls come on, and as well as some of the difficulty increases in mining in the near future as well.
Yeah, I think also to add to that, I think to go back to when that occurred, not only is it that one event, but as you pointed out, right, there has to be this enabling for the institutions to come in. Unlike a retail participant who can operate on their own volition and decide how to allocate very quickly, when you are an institution, you've got an entire wrapper of regulatory, legal, and customer arrangements. So this is going to be something that, with institutions participating, that is going to be a long, ongoing process. There are some institutions that are coming in. Many of them are probably thinking of themselves as front-running the next group, not front-running in a bad way, but anticipating where the ball is going to go to next. If you are an institution, you've got an entire infrastructure that has to be changed. This is not stuff that happens overnight. Even if you are what is considered to be a very flexible operation, like a hedge fund, you've got to mandate the legal documents that you send to your investors stating what universe of strategies and assets that you're participating in, what custodians you're using, what service providers you're using. All of those things have a huge impact on what your ability to do things are. And that's not even getting into conservative entities like pension funds. Endowments have actually been rather forward-looking in this. Family offices are usually very forward-thinking and have significantly more flexibility. But there's a lot of paperwork that has to be done for existing institutions to actually move this over, which means that this is a potentially long process, which is good. I mean, that's something that's going to sustain us going forward for a long time to come, as this rolling even 0.1% or 0.5% allocation to crypto hopefully continues.
Sounds like it's great news for the lawyers, Ari.
It always seems that way, doesn't it? Yeah.
They were the only ones winning during a winner. It was their lawyers' market more so than anything else.
Constantine, you want to chime in?
Yeah. Well, I guess maybe it was not like that fresh of an information. I guess it started from an interesting survey that, to me, like Fidelity Digital Assets, like where they did a survey of 774 different investors, half from Europe, half from US. And what's the highlights of this story was that 1/3 of them, actually 36% of institutional investors, they currently invest in digital assets. So the entire narrative, like the entire, like, the necessity, like, of allocating, as my colleagues and Ari were saying, like, that's no longer an option. Like, I tend to say, like, it's very simple. Like, and if you're a CIO or a CFO of an organization, you're allocating 0 to digital assets, you're going to be fired. It's very simple. So, and right now the perception changed, which is also interesting. That before, a lot of investors, they were quite negative, even though they had to like learn about it. Now the 60% of the people are actually have neutral or positive perception. Then the appeal to just even building the infrastructure, 80% of the people are saying that all the banks, all the technological players in the market, whether you are a payment processor, whether you're a custodian, whether you are a clearinghouse, or like all the people are now building the infrastructure. So that changed, like I think the categorization, like, and the mindset of the people, they are getting more and more educated now. Like people are starting to understand the difference between the cryptocurrency, like just utility token, a stable coin, or a central bank, like digital asset. So yeah, and that I think is important. And I guess I'm more excited the last days, like what is happening, like, in the other part of the world. I would say the Wall Street bats and the crypto punks who are crushing the little guys, as they say in CNBC, that are crushing the bigger guys on Wall Street. That is, I think, really fun to see. Elon Musk, Alex Ohanian, like, Jack Dorsey are using hashtags in Twitter, like, Bitcoin, and the price has surged like 20 to 25% in one day. That means not only institutions, but also retail folks are uniting. I think consolidation of efforts is another trend, and a very important one. People start to get it. People are using it as a tool to demonstrate their unique position and their unique choice of where they're going to allocate their assets. And I think the fact that we're doing it as a one unified entity, whether it doesn't matter whether you're just like having some fun to do it on Reddit, like subdomain, like named Wall Street Bets, or anywhere else. I think the fact that people are starting to wake up, I think that's an amazing trend by itself.
I think it's a very, very interesting topic, especially, right? You know, we're supposed to be a panel of experts, right? And there's this whole thing. One of the themes, right? There's it's such a rich topic. You can take whatever you want out of, you know, the whole GameStop situation, and it's you know, but one of the themes is what makes an expert, right? Because I think there's a lot of things, like you said, like one takeaway that I hadn't gotten was exactly what you said. So I like your call for unity, you know, that we're all together on these things. But I think
Are you running for office?
What's that?
Are you running for office?
Yeah, heaven help us. So, So I think that the whole expert versus non-expert thing is particularly, I think, poignant, because one of the takeaways that I don't think has quite really been appreciated is, you know, probably going to piss somebody off, but man, how bad the so-called expert was at their job. And the reason why I say that is, by the way, not because money was lost. There are plenty of times that as a trader, you make a bet, you lose money. That's what it is. But to take a position that is so large, and do so for those that may not, I'm sure, are at this point familiar, but there's a certain amount of shares outstanding, and the amount that was shorted was a multiple of the available to actually get. So essentially, they painted themselves in a box because there was simply no way that they would realistically be able to cover very easily. And they were putting themselves at great risk at a time when the stock was actually extremely low. So that's why I say they were so extremely bad at their job. And here the so-called, you know, non-experts found that out and exploited that and really put it to the so-called expert. And it's kind of interesting that, to me anyway, that whole dynamic of expert, non-expert, holding office, not holding office, and so on. I'll leave the rest, but but I think that's very interesting in the context of crypto and decentralized and centralized exchanges and so on.
So that really becomes heavily exasperated with a group like Milton, because Milton Capital is really a cornerstone institution for due diligence on Wall Street. I mean, they have hundreds of copycat funds that follow them that don't have the ability to produce the same level of diligence from an engineering or analyst standpoint. So, you know, these other funds, you know, maybe in the hundreds of millions, just simply follow the moves that Milton's doing. So there's a cascading effect here that's taking place from a failure at an institutional level, you know, up at the top. I think that the greater thing to keep an eye on, and I think this is going to be a huge tilt of the hat towards blockchain and decentralization, is how fast these institutions that were providing retail support shut down or brought down, whether of their own design or not. I mean, one called a Ameritrade down, one called a Discord, Wall Street Bets down, you know, one called a Reddit, and, you know, there's interruption service on Wall Street Bets, and the list goes on, and obviously into Robinhood. So the motivations of that decision, we still don't fully understand yet. But, you know, I think this is just going to lead further into the decentralization conversation, where you can't run into that, where you can't shut people out. You can't shut community or retail out, or even institutions in some instances, right? And I think there's just an inevitable crossroads that we're coming to, and this is the type of event that expedites it, right? Just like COVID, for the most part, expedited a variety of things in the crypto landscape, right? And obviously, no one wants a pandemic, but I mean, it really pushed the industry forward probably 3+ years in a very short amount of time, which for crypto is a lot, right? A year in crypto is like 20 years in almost any other industry, it feels like. So to be able to catapult ourselves 3 years forward, and then have events like we have happen this week with GameStop and AMC, and just the retail fervor and individual retail power, is going to, again, I think, kind of leap this thing forward. At Republic, we're really known also from our crowdfunding perspective, right? Where our whole mantra is the democratization of finance and access. And we've been pushing that for a long time. And even very much from a legislative perspective is now we've been able to increase the Reg CF limits from 1 million to 5 million here starting in March. And you're going to start to see more of that democratization and retail unaccredited access. And what we're seeing at GameStop just furders that narrative that there's a lot of power behind that, and a lot of interest, and it's not going to stop growing at this point.
If I may, or go ahead, Danny.
Please go ahead, Connie.
No, I think it's just generally exciting topic because you see we can go ahead and talk about like something like BlackRock, right? I know the biggest asset manager in the world with almost like $9 trillion joining the game, like like spearheading like the application into SEC for their like 2 funds to have a derivative play for futures to essentially like. Again, I'm not going to criticize them, but essentially to potentially manipulate the market the way they do, like in a traditional world. So it's a good thing. Like I guess actually it is a good thing. So when we talk about institutional adoption, there is this mantra that because there's a new flow of capital and the market cap will grow in crypto, that will change a lot. That will actually become like introduce the stronger perception in the market that the market cap is bigger, then hopefully volatility is even lower and people have more confidence, blah, blah, blah. Maybe if it's over $1 trillion, the ETF will be accepted, and then we're going to have like
2 trillion.
Huh?
She said 2 trillion. That was her number.
Okay. Well, 2 trillion, whatever. Like I think there are numbers that
trillion here, trillion there. Pretty soon you're talking.
Yeah, it will
you
go
can have
there
one,
anyway.
you can have 2.
Exactly. So I think it's all realistic. The thing is, what I'm more concerned about that actually now, like small guys, like as they call like, the retail investors, they have more edge. Like so we like as a community, like the smaller investors, they have better opportunity to actually have the voice, to have to vote with their capital in the projects where there is a governance opportunity, like, and especially in the truly decentralized applications, they have an opportunity to actually impact the direction where the project is going because there is no owners, there's no shareholders who want to squeeze you. Like, there is a common desire to grow and to become something bigger, to implement those, like, I would say not idealistic, but realistic ideas to make it cheaper, faster, and better for everyone who are using the particular chain. So, and the bigger the game will become, the harder it will be actually for the smaller guys to have this edge. So, I mean, not to say that, there's pros and cons in every strategy, but I guess right now is a beautiful time that we have to appreciate. It's a moment in time and space where it's still pretty early. It's still early adoption. And we, like a lot of folks, have this voice, and we have the opportunity to see those beautiful moves. Later on in crypto, it will mimic more and more traditional markets, and it'll be harder.
Agreed. Constantine, if I could just follow up on that last point you made. We've touched upon a couple of topics. There's democratization. There's unity. Thank you, Ari. We're all feeling more unified. I'm feeling more unified now. There's the idea of the different dynamic in terms of how much retail drives, and that's the whole retail community versus how much the institutional, this latest new larger wave of FOMO money coming in from Wall Street, how much that's driving and changing the ecosystem, not just asset prices. But if we talk about where we're at and the role of these different segments in the market, what I'm curious about for 2021 and beyond is DeFi. DeFi is, I'm not going to lie to you, 8 months ago, I couldn't even spell it. I didn't know what it meant to me, to the firm I was working for at the time, to my clients, to the ecosystem. I hadn't given enough thought, hadn't learned enough about it, and still have a lot to learn. But like, just look at what has occurred in the space just since last spring. And you start to see the emergence of these players that are getting more investor capital. And mind you, that's crypto native funds, but that's who should be going in. People who've done their diligence, understand it, and understand the risks, and also want to foster the growth of each one of these pools and of the entire system. What's interesting to me is, where do you guys think we'll be in a year in terms of broader adoption? And I don't mean a BlackRock playing in DeFi. I mean just broader levels of adoption as you go up through the different strata, from pure super cypherpunk to, mid-range, kind of crypto native, and then beyond.
Are you asking from like a speculative asset nature, or are you asking from a technology deployments perspective?
I'm actually interested in both. I think the latter part's more interesting, because if you spend enough time, and I've been fortunate to do that over the last couple of months, trying to understand what does DeFi mean in the long run. Those pools, those protocols, these new models and platforms that succeed and are truly innovating, then you start to think about what it can mean if you really, it's not so much replacing today's legacy financial services infrastructure and markets around the world, but innovating and permeating those markets, and those innovations becoming available to a much broader range of clients, of industries, of players, of firms. I actually think it's going to accelerate faster than a lot of people realize, just based upon the value of these innovations.
Yeah, I mean, I can tell you from the Republic perspective, our advisory arm is probably the most pronounced in the space. And not only do we work with the startup side, but also the institutional and enterprise side. Without a doubt, it is explosive. I mean, the amount of enterprise companies that we're working with at this point, Fortune 500s, every single person or every single Fortune 500 company at this point, if they don't have a blockchain department, it's on its way. Right. And that's a big part of the often discussion. So, and a lot of it's really exploratory, which is really interesting, right? Like, we know this is interesting. We know we need this. We're not sure how to implement it yet. Whether that's, and I won't name specific names, whether it's large insurance firms or huge retailers, sports franchises, these are all people that are rolling this out already. And if it hasn't been deployed, it's going to be deployed, within 12 months, some type of solution. Constant POCs. I mean, we probably see a dozen plus institutional POCs a week, or requests for. And then beyond that, you start looking at central banks. Every central bank on the planet at this point has a digital department or digital asset department. Figuring out how to use it, how to work with it, how to protect themselves. So I think for the most part, probably the standard retail individual doesn't have exposure to that. They don't see it. But I can tell you that it's prolific at this point, and it's much farther along, I think, than most people realize.
I'd even add, I think that's a very forward-looking and very valuable perspective. Even taking a step back into what one might not think about as being strictly DeFi per se, but I think crypto has, because of the way that it came as sort of its Wild West and sort of outlaw sort of reputation, forced it into a number of things that created a lot of innovations. So that sounded very fancy, but what do I actually mean by that? People talk a lot about prime services, and especially for people that come from traditional finance, they go and they look and they say, oh, we don't see a prime broker in the way that we saw it over here. And you know what? That's true. So the question you have to ask is, why? Right? Is it because there's an insufficient demand for it? Clearly, people know what prime brokers do. They understand all of those things. Certainly, there isn't necessarily a big balance sheet that has stepped in to sort of provide a whole lot of things. But on the other hand, there is a lot of leverage and in the market itself, right? So when you go to a lot of crypto native exchanges, you can obtain a lot of leverage. Well, a lot of the reason why you go to a prime broker was because you wanted to get leverage. A lot of the reason that you might, as a trader, be at a bank or be at a proprietary trading firm was because what you wanted to avoid is, you were fine taking the risk. You just wanted to really make sure that when you walked away, you didn't like lose your home, your neighbor's home, and the home after that. In other words, lose more money than you put in. And having these various institutions enabled that because they covered it. And for a variety of reasons, which aren't worth necessarily going into. But that sort of infrastructure is out there. I can go over, maybe not me as a US person, but one can go onto an offshore type exchange, offshore from my perspective, not to others, but to one of these exchanges, participate, and should I get liquidated, it's no harm, no foul. That's part of the game. I'm still welcome back as a customer. That's fine. I got liquidated. It is what it is, and everybody's fine with that. If I did that at my futures broker and I put in 10 grand and I lost 20, they're coming after me. So it's a very different dynamic. Obviously, in the case of some of these Bitcoin native exchanges or other native exchanges, they aren't going to allow you to just lose that money. They will auto liquidate you. But it seems to be what I might call a DeFi prime broker or this distributed prime broker. It's a lot of the same services that are out there. So I know there's a lot when people talk about DeFi, it's very exciting. There's everything from Uniswap to just people going to blockchain and so on. But even on sort of more of the vanilla stuff that we're all used to, I think it's unrecognized how much distributed finance infrastructure there is out there.
Yeah, I guess I might add a little bit because we are right now actually actively looking into some of the yield farming strategies, and we're looking to probably roll out a product like a fund that will be yield farming like product. The reason why we sincerely had a conversation internally, like we have cover call option strategy where we pick it back on the volatility of Bitcoin, and we pay 1.5% premium, basically like a fixed income like product like per month, and then on top of it, sometimes it's much more. So and then there's alpha on top of from the trading. We have a whiskey product where we tokenize whiskey distillery, so just an STO game, which is just fun, and maybe later on we're gonna grow bigger. Maybe we're gonna list on Republic. Who knows? For now, we've signed a letter of intent with INEX. So we have wealth management arm, we have VC arm, and we realize there's one product that we as a firm, like as Way Financial, we haven't tried yet because we're so caught up with other things, but with everybody on a side, we're investing individually into the DeFi space, which was ironic. Like I'm sharing right now something very personal, like which again, I'm not sure I have to do it like online, but we don't have a lot of users, so whatever. The idea was beautiful because we saw how is it also like possible that the several layers of yield is unlocked. I think that's the beauty of democratization. Like, if the bank, even if they had good intentions, they're not able to pay out even 8 to 10% APY year on year, just not able because there's so much costs involved into other operations. The smaller guys who are redistributed, they have like small costs also to run those yield farming or AMMs, and they have an opportunity to redistribute the wealth among the users. So which is, I think, just by itself, it's a beautiful concept. Like it's innovative, and not only innovative, but it's also lucrative for a lot of players. And in time, we're going to see that the yield will come down. So it's going to stabilize, and it's not going to be so crazy amount of money. But there's right now, you can go to Chainlink, you can go to Synthetics, you can go to Aave. I mean, you can go to a lot of Compound, and you can make just 10 to 20% per year, like in stable coin, which is insane amount of money if you consider that in some of the world multi-billion economies, they're not like the inflation killed all the economies, and it's negative rates on any investments, if you're talking about bonds or anything, so at the same time, the smaller projects that are managing merely like hundreds of millions, I did a note here, like the entire total value locked in DeFi is projected to hit $50 billion. I mean, it's minuscule if you compare to the global market. Right now, it's what, 25?
Yeah, I think barely 25 now, right?
Yeah. So in DeFi Pulse, you can actually track this information. It's public information, and I mean, and that is impressive. You can actually audit at any point of time if you want any of those organizations. Like you don't need to wait for quarterly report or yearly report. I think those are aspects that are just impressive. We're now seeing slowly but surely a shift into more transparent and more democratic finances.
Yeah. And one of the points that you make there, I think, is kind of the sleeping giant on the institutional side is once some of the larger institutions understand some of the additional financial mechanics associated with some of these crypto assets, and this is a question that we answer fairly regularly for those guys, but understanding things like yield farming and staking and areas where you're able to make additional alpha or beta points on those assets beyond just potential upward price velocities. And the more and more they start to understand that, and the more and more that there's infrastructure built that they can leverage, they're not going to build it themselves generally, right? They're going to look for services that can offer that. And there's like a gold rush right now of people building out that infrastructure, which is great. I think as we start to see the institutions more and more have a better understanding of how that works, what that looks like, what the risk profiles are associated with it, and the actuarial guys then having to build out like understanding, all right, locking up liquidity for X and what is the long tail value of that versus not having liquidity. Eventually those formulas are going to be put together. And as that starts to come together, long term, I think you're going to start to see the landscape change quite a bit. And it will be really interesting to see what happens with the overall access and liquidity of the general markets when the value of holding the assets continues to increase or at least stabilize from that perspective. So I feel like that's kind of like the sleeping giant that hasn't really woken up just quite yet. I know in how we manage our treasury, that's a big conversation. And we're starting to translate that onto others.
So I'll fully step forward and say that I'm not, intimately familiar with a lot of these yield farming strategies. You've definitely piqued my interest, but in a world where, as you pointed out, there are negative interest rates and so on. What is it that they are doing that they're able to return 10 to 20% to the investors? And related to that, is that coming back? Are you talking about you put in a stable coin? Are you receiving the yield itself as in a token, or how does that work?
Yeah, normally it will work USDC or USDT depending on what platform are you talking about, and then you have native tokens like in some of the, depending on there are 3 different types of stable tokens like DAI, compound, you have. Depending on the collateral, one is I would say something like simple, really simple to understand. USDC, USDT that is pegged 1-to-1 to dollar, right? So it's collateralized by dollar. You have other synthetic stable coins that are collateralized by other cryptos, which is more complex to explain. And we will not have enough time even to have this conversation, but and some others, they may be collateralized with other assets, right? So it may be even something real, like let's say by gold. There's those projects that are rolling out, or a basket of different currencies. Like if you remember the Libra, they were trying to collateralize their token with 4 different currencies. So multiple different experiments. I call them not only financial but socioeconomical experiments. So this is number 1. Number 2, the way they can achieve so great returns is again because their cost of running business is so low. So if you think about like how much you need to pay out, like, in salaries and supporting the infrastructure, like all the expensive servers, like renting buildings, everything, the cost of running a bank is huge, so and plus they take a lot of the profits, it goes to the C-level executives, like, and there's cascading towards, the smaller guys who are just, not ripping all the creams, they're just, getting what they're getting. And in this particular model, like if you think about it as a principle, right? 20% of the efforts and 80% of the of the like reward and results are coming. That's in practicality how it works. Sometimes it works even 10 to 90. So the automated market makers, they're actually redistributing the wealth between the borrowers and the lenders. Like, they are redistributing the opportunity to make money with them. So they share sometimes like 90 to more percent of the percentage, like with the people who are actually lending their tokens. So you can deposit USDC or any other, you can deposit Aave, you can deposit Chainlink, Cardano, like any other like token, and there is a different, sometimes it's floating, so there's no fixed rate sometimes. That's another element that you have to take into account. But the beauty of it, if you don't have a lockup for a quarter or a year, you can even take out money whenever you want, which is another beauty. Like, and it's fast. It's easy to understand what is happening. There's a risk, obviously. I think it's just, and I will stop for here because I'm getting too excited. So, impermanent loss. There is another. Yeah, it is permanent loss. That's another important risk I would want to voice out, because there is a topic that, you can have 10% yield, right? But if the price of the token actually goes down 20%, then all your yield is eaten up. But the question is that, if you're a believer that's in time, the price will actually go where you're expected to go, it's still lucrative because you have an ability to have the yield in the native token. If you're a non-believer, just use stablecoin. It's 1-to-1 to dollar. Yeah, you will have a smaller yield. Let's say it's 6 to 8%. You can use platforms like Nexo, like Celsius, like BlockFi, or
Voyager.
Voyager, yeah, a lot of other platforms.
Voyager pays 8.5% annually on USDC. Just holding it in there.
So that's a good point. So what you're saying is you're going to go put it on these other platforms that are acting as a bank. So now you've actually, you've introduced credit risk.
Yeah. Correct. Well, yes, a format of that. Yes. Yeah.
That's right. They are acting as banks. Effectively.
It is credit risk because you don't. It's I understand the AMMs. They are providing a service. They're doing it in an automated fashion. They're not going to be perfectly efficient, but they return a lot. And just in general, that's a good business. So they provide a service and they distribute that, and it is what it is. I get that 100%. But when you're like, what I'm interested in is trying to figure out, like, or the reasons that these returns are there is because they're taking what might be available as a 2% return and then, leveraging that up on the back end so that if there is something, some sort of hidden tail risk that we're unaware of, does that come and bite you later on? But because it's a low probability event, might take a year or two or three to evidence itself. That's what I'm trying to understand on the back end. I know that many of these firms are well run, and that's, for sure. But, even at, very highly respected places, these are still relative newcomers. There aren't, audited financials and so on. So that's what I'm trying to wrap my head around. I don't really, for instance, with Aave, I really know very little at all, or what Compound does, or what happens on the back end.
Yeah. Voyager is interesting to look at because they are a public company. So there's, quite the paper trail associated with what's going on. A lot of the times it's really lending into liquidity pools. It's like the big piece of it generally, where you have either traders, institutional, otherwise, that need access to short-term liquidity like immediately, and it's like a bunch of microloans that are just taking place on an automated fashion at high cost, right? But high cost and a high cost to the user, but a low cost to the institution that's providing it, right? And that's what's causing kind of these higher interest rates than that we'd see. And this is kind of what Constantine was kind of alluding at, is these larger players have the ability to do these micro lendings into these liquidity pools that doesn't cost them anything to do. A lot of it's done in smart contracts. It's all automated. Like all the bookkeeping components, there's no legal fees associated with running these types of contracts. So they can charge, say 10% on the money, pay out 8.5% to the liquidity provider, the individuals providing the tokens, and then eliminate most of the risk, since it's all done in an automated or smart contract fashion. So
clearly it's a super efficient model for a lot of people in the space, and the evidence is there, and therefore, thus the growth over the last 2 years. And it's just such early days. I mean, it's not for everyone, but I think the evidence is there that it's a very efficient model.
And needed. If you look at major market makers in the space like QCP and Amber or Grapefruit or whatever, they rely on those liquidity pools in order to orchestrate a lot of what they're doing. So that's only going to grow, and especially as the assets grow, right? As more and more assets gain more traction and more notoriety, whether that's from a engineering perspective or from a speculative trader perspective, those pools are just going to become more niche, and with that more expensive, right? So there's a lot of interesting processes where you can do that yield mining, and if you have a diverse portfolio, you can really spread that around. And this doesn't even involve things like staking and governance and other aspects of the ecosystem where you can be involved in also kind of making this, right, and being a more active player. So this is what we're talking about here, is a very subtle, non-participant, set it and forget it type of situation. So like, again, I do recommend take a look at Voyager. It's actually a great product. Coinbase competitor. Their iOS is great, but yeah, I think they pay 8.5% on USDC, like 6% on Bitcoin. Again, if you just have your Bitcoin, with them as a product, you get these annual returns. I mean, you could run a fund and just have, if you just got 8.5% on a $20 million fund every year, I mean, everyone will love you. So it's again, this is kind of this shift we're going to see, and as the institutions get more and more understanding of how to leverage these tool sets, I think you're going to see a lot of changes in the space.
Yeah, and I can add to that, like, we have even better rates than a lot of those folks, just because we serve some of the crypto whales, so we can get some of the institutional rates from the providers that work with those folks, so that's why we bypass everyone in this context, right? So but that's for the bigger ticket size, so that's and for the smaller folks, what is amazing, and I think Andrew touched upon this a little bit also. So something as Uniswap, for example, or like Balance or Curve, you have hundreds of different coins that are listed there, have different pairs, you can instantly swap the tokens, and the fee is minimum, that's very low fee. And I think the more technology is going to advance, those decentralized automated liquidity pools, they will become bigger. So what it allows you, without being a professional trader, to deploy money into this pool, and essentially you're becoming, in a way, you're becoming part of a market maker. So and they're not open to anyone to provide liquidity, but the more I would say democratization comes into play, the better they're becoming into again, allowing everyone to participate. And I think just the fact that you can have only $1,000 or $10,000 like worth of your crypto assets and can participate in this is just impressive. And as you know, as Andrew mentioned, if you have like 8 to 10% yield like year to year, that's a separate strategy. People can live on this.
Let me throw a question out to the group. Konstantin, you talked about the fact that Wave is considering creating a new DeFi fund project, for lack of of labeling any differently. So a new product that you can offer to your clients that's going to capture some of the aspects and the returns and the unique innovations of DeFi. If I want to ask the three of you, if you look at the world of actively managed crypto hedge fund or crypto fund management groups, let's just say in the Western Hemisphere, those that have been in business a while, have a decent brand, a track record, assets under management, have done pretty well last couple of years, but haven't yet have so far done very little beyond, there's a BTC fund, there's maybe a top 10 liquid coin fund, maybe active managed, hedged here or there, basis trade, but haven't done much real DeFi other than their PAs, but as far as the products they're offering to clients, how many of those of Wave's competitors effectively do you think are going to launch something similar this year in percentage terms?
I don't know. And I can see that I don't think there are enough people who actually have expertise and ability to launch such products. It's actually, you would think that it's simple. It's not that. Like the only thing what I would say, like an honest criticism towards these products. I mean, if you don't know what you're doing, you can be also wiped out pretty fast. Like I've seen strategies with 3 to 4 different layers how you can create, let's say, one of the strategy I'm selling it like easily, like so you can stake money in synthetics, you can buy SNX, stake it with the minter pool, then you can mint SUSD, then go to Curve, then basically stake it in Curve, and then you go to Balancer, and this is continued. You have to always actively track what's happening there. Now you have Zapper, you have other opportunities to see holistically where your assets and whether you're using Trezor or MetaMask or Ledger and other opportunities here. But it is still not that easy. In some of the projects, you always have to double check the rewards. They're not automatically rewarded to you with the free tokens. In others, you have to look up the ratio between your collateral. So there are a lot of things that can go wrong. Let's put it this way. So the people who actually
it can be a painful learning curve, is what you're saying.
Exactly. You can also easily lose money. So it's not an investment advice just to go and put all your money just because you can have 8% yield, right? You have to be very, very careful, because those strategies also require they require certain tax avenues, so, and also financial understanding what the hell you're doing.
And depending on jurisdiction, certain licenses. I think that's really probably the biggest gatekeeper to this, right? Exactly. Danny, to answer your question, how many of those companies are gonna pop up? The answer is a lot, but how many of consequence? Probably not that many, because it's not an easy place to get into, right? It's not something that you can spin up, overnight. It requires infrastructure, requires an incredible amount of domain understanding in order to be able to compete with Wave and other players. And then again, jurisdiction for that type of business is incredibly important. Where are you domiciled, and what does that structure look like?
There's some KYC challenges as well, of course. The bigger money, yeah. I mean, it's just
custody is even better, even bigger challenge.
Yeah.
For example, we as an IRA, registered investment advisor, we can work only with qualified custodians, and we have a very highest fiduciary responsibility towards our clients. And that as Andrew mentioned, there's a cost to that. We're paying 6-digit numbers just to maintain this legal and compliance hurdle. How many firms who are starting can afford that?
Yeah, and it's not a cost that ramps up slowly, That's another piece, right? It has
Oh,
a
yeah.
huge upfront lift. And I mean, some of it can be templated because there's some of it that's been done at this point and been distributed, but you're still, I mean, you're starting with a huge weight on your shoulders right out of the gate. Yeah. The compliance legal jurisdiction component of anything in crypto, I think, is often underestimated. You know, it's probably one of our biggest focuses at Republic. I mean, we have 11 attorneys in house. Since securities law, I mean, our CEO is an attorney. You know, he was the general counsel for AngelList for years, and you know, so that's something not to be overstated. And you know, one of the great things about the U.S. is there, especially recently, we've gotten some really clear direction as far as, you know, what type of swimming lanes we can operate in. But that being said, you know, being able to navigate that appropriately, and also keep in mind that there's going to be a lot of oversight, and more oversight this year than ever, and that's only going to increase. So
those compliance costs are only going to continue to increase. Obviously, more lawyers, more compliance,
Yep.
more layers.
Yeah.
Yep.
Well, that's what we started with, right? Lawyers are winning. Yeah.
Yeah. The only thing that I would add to that, because I think that that's very well covered, is that in addition to all of those things, I don't think you're going to see a lot of traditional market participants cross over, you know, into that particular space. Even if they do cross over into crypto, you know, I think that there's a certain a large part of the strategy when you're talking about existing companies is, you know, don't burn down our existing business. And I think that there's, I think rightly so, a perception that there's a lot of risk in these, and a lot of hidden risk that is not showing on the surface, you know, akin to essentially, right, you know, I forgot what the name of the firm was that blew up before Melvin. We had other people that blew up.
Citron Research?
Well, that was on the GameStop one, but there was the guy who had the option selling strategy that blew out. Was it that must have been like March, April when the market tanked, right? Was that when the guy came out and he was in tears on YouTube apologizing to everybody?
I know.
But you know what I'm talking about. You know, so, you know, for me, I will tell you straight up that Constantine's excitement is infectious. Maybe a poor word given our current world, but nevertheless, I'm very excited about looking into DeFi. But, you know, having been in the markets for a long time, this strikes me as having a lot of embedded leverage, and being the equivalent of, you know, short tail risk somewhere in there. This stuff doesn't come for nothing. That's just my view. Happy to be proven wrong, and I'm excited to take a look into all of this. But to wrap it for the institutional, I think that's gonna be a long road for them. I think, you know, Constantine, you're gonna have a clear lane as far as the traditional markets participants.
Guys, I think right now might be an appropriate time for me to do some shilling. So, because you know, I know our audience has been waited very patiently for the last hour, and I hope they've really enjoyed this. But you know, when we're not talking or thinking about crypto, liquidity, institutional versus retail, DeFi, the future of the human race, what I like to talk about is rock and roll. So for all those out there this weekend who haven't checked it out, check out Old School Vinyl.
Shout out the devil.
It's a great podcast. You can get your Motley Crew there if you listen and you're patient. We'll get to it eventually, Andrew. And all your favorite bands. It's my favorite podcast about classic rock and roll. That's Old School Vinyl. Check it out on Spotify, Apple Music, and wherever you get your podcasts.
That was so velvet.
Yeah, that mic.
I love this microphone.
Mike is so good.
So shameless.
Yeah. I'll do my own so long as we're here. So I know you guys are at Republic and at Wave. What we do, I'm at Digital Gamma. I'm one of the co-founders, and we're working on a repo product, which helps investors, particularly from the traditional side, embrace Bitcoin and understand that there are these opportunities for lending. We prefer a collateralized viewpoint, which is a little bit more safe. But there are significant opportunities, and we see it as we say, the ability to get junk bond yields at investment grade risk. So for you investment nerds out there, that's our pitch. So.
I don't know. I can go. So like we are, asset management firm. So we have different hats. We have VC arm. We have wealth management arm. We run different strategies in different hedge funds. Right now working also on an infrastructural fund with Cardano, by the way. So we're going to stake some of the the staking pool we're going to create with them, and we're also launching a VC fund with them to help invest in infrastructure. So anyone who's building something on Cardano, please, let us know. We'll be happy to cooperate. The last thing I will say also, I'm also having as a product placement, also having a YouTube channel and a podcast, Holistic Investment, and where I interview a lot of interesting in people, like ranging from investors to entrepreneurs, like in the space, mostly in the space, a little bit of VC mix, but mostly people who are very directly working in digital assets, ranging from asset managers, prime brokers, custodians, and just people who are very knowledgeable in the space. So yeah, I'll be happy if somebody would listen to it, or if you know some of the people who you think I should interview, also happy to take a look.
And then I'll hop in just about Republic for those of you that aren't familiar with us. Spinoff of AngelList, actually, about 2017, originally built on the Jobs Act. We were focused on regulation crowdfunding, Reg CF. Around that same time in 2017, the ICO boom happened. So we realized that ICO is just another form of crowdfunding, and in some cases a better form of crowdfunding. So that's how we got into the blockchain space. As it stands now, Republic is 3 divisions. Reg CF still very much at the forefront. It's very consumer facing. So if you're looking us up, you'll see a lot of that. Again, all about democratization of finance and access for people. So Reg CF side, then we have our venture arm known as Republic Labs, investing, syndication, allocation through a really large cultivated LP network. We do a couple $100 million through that every year. And then we have the blockchain division. So I run the blockchain division, includes our advisory arm, working with startups, enterprise, governments. We have our own tokenization platform, minting on ERC 20, 1404, Stellar, Algorand, Tezos, soon to be Binance Chain. And our just now launching token sale platform. So we'll be running our first token sale fully compliant in the US with retail access here coming up in the middle of March, and more on that later.
That's awesome. You guys had a big year last year. I love what Republic's doing in the space. Yeah. And I think imitation is the best form of flattery. So I anticipate other folks will be doing what you're doing. Maybe not exactly the same thing or as well, but I love what you guys are doing. And of course, I'm a big fan of DigiGamma and Wave on a personal and professional level. I'm still a free agent, but I will be updating my LinkedIn profile next week. I'm excited to let everybody know what I'm doing. But right now I'm having a lot of fun in the crypto space when I'm not talking about rock and roll.
By the way, albums on the live album list, 10 through 6, I rate better than 5 through 1.
See, that's what we like. We like a little bit of debate, a little bit of tension. Maybe next season we'll do it again.
Perfect. Let's do it, guys.
Guys, it was a real pleasure meeting all of you. I've learned plenty from all of you, and this was great.
Likewise, gentlemen. Thank you so much.
Thanks, guys.